Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. Thank you for taking time out of your busy Wednesday mornings to join us. Happy Wednesday, October 12th. My goodness, into the fourth quarter we go. So as you guys can see, bottom left-hand corner of your screen, futures have been quiet following yesterday's volatility and the news out of the Bank of England. It all started last Friday with the non-farm payroll report coming in hotter than expected. Unemployment rate of 3.5% compared to the forecast of 3.7%. I think the U.S. economy added somewhere around 264 or 3,000 jobs. Obviously not what the Fed wants to see as it attempts to control inflation with the recent rate hikes. And now with the September Consumer Price Index report upon us for tomorrow morning, things are going to get even more interesting, we feel. So we're going to get to the charts in just a few minutes. Before we get to the charts, we're going to bring in the trading analysis team, including company founder Todd Gordon, now Director of Investments for New Age Wealth Advisors. Good morning, gentlemen. How you doing today?
Good morning, guys. How's it going?
Doing well.
Hey, guys.
Hello.
Thanks for joining us, everyone. Hope you guys are well. Fun times, huh? Fun times.
It's always fun. It's never a dull moment in 2022.
Never, almost every day. That's what's great about life in the markets, man. You get up and almost every day is different.
Exactly. It's always something new. Always something new. So is it raining in upstate? Is it storming up in upstate New York yet?
No, God, we've got nice fall, sunny weather here. It's good.
Nice.
Everything's good. It's good time of year here. Went for a good long mountain bike ride last night. Get the head clear, and I don't know about you guys, but the older you get, the more you have to work out. I guess, related to that last topic, the more you're entrenched in these markets, the more you're thinking about it, especially as you get over 40, Bennett. I think you're going to find out soon enough. You wake up late at night, 3 a.m, and you start thinking about things and thinking about the business, thinking about the markets. There's so much going on, man. The only way to shut that brain off that I find is you have to work out. So I woke up, I roll over, and usually I can tell is at like 3:11, 3:15 in the morning. I think it was like 3:30. I was like, okay, fell back asleep and wake up fresh. But anyways, got to work out, especially when things are busy and so much, so much data flying at you and I don't know. That's just my call, but I don't know what you guys think.
Yeah, no, absolutely. You're spot on there with that. I would get out recently, but here in Central Texas, we've been plagued by some interesting allergies. It's always a good time. Always a good time. What about you?
Come on up here in the Adirondacks, man. Clean living. Crazy New York, but clean living 4 hours north of the city.
I love it. I got to come check it out. So what about what about you, Terry?
Oh, man, I finally got my Corvette past the break-in point. You guys saw that little video.
Got it past 100 miles an hour?
No. I haven't got anywhere I can drive it that fast around here yet. But no, I got the 500-mile break-in, so we've got the full power at least. That car is fun. Let me tell you what, it is quick and fun. But yeah, I'm having a lot of fun with the Corvette Club guys too. We go to a lot of different shows and stuff, and I wasn't
Nice.
with them last week, but they were driving the homecoming queens at one of the local schools around the track, right, with the Corvettes, and the homecoming court would sit up on top of the Corvette. The coupes, right? So you get the back end of the coupe. They put a towel or a blanket or something, and the girls sit up there and they parade them around and stuff like that. And I think we got a Veterans
nice.
Day parade coming up next month.
Oh, nice. That'll be fun.
Do stuff like
Nice.
that, and then there's a Blue Santa as we're coming into Christmas. We go help out the local police department, raise get toys for tots and things like that. So all kinds of different fun things to do.
Enduro says,
That's
Terry, born to be wild. I completely agree. Dude, they actually had a police escort on one of their most recent trips. It was pretty neat. Pretty neat.
Yeah, that was a good video.
So what do you guys think with CPI on deck? What are you thinking in the markets? Any comments before we get into the charts?
The only thing I can say is it's another lagging indicator, and that's just so all the Fed wants to see is bad news right now. But the problem is that they're looking at the lagging indications rather than the leading indications. You know, you ought to be looking at the fact that energy came way down. It was $130 a barrel earlier this year. Did you forget that? Yeah, it's running around 90 right now, and it may be rising, but you know, it was a whole lot higher. Commodity prices have come back down. So those things that are leading indicators of inflation getting better are showing good, but they keep looking at these lagging indicators that take months to turn the battleship, and that's just you know, I think they're just going to keep waiting. So
I mean, that's what I think what's happening. The market, you know, we were starting to see in the last 2 weeks commodity futures trading with stock index futures, right? And that's contrary to what you're reading in the news right now, which is,
yeah,
you know, if commodities are making a move back up, inflation's a real problem, so stock index futures should be selling off. That's not what you're seeing right now. You're actually seeing crude and S&P trade together, which means I think the markets are looking past the fact that we will see a 7 and a 6 handle and a 5 handle in inflation. And if you look at the long-term tips market, 5 and 10-year tips, you know, they're pricing at 2.5% inflation, which is right where the Fed wants it. The markets are trading on the idea, the possibility that central banks are going to go too far, too fast, using that lagging data, pushing us into inflation. So that's what's creating the correlation right now, in my opinion, is central banks gone wild. But, you know, RBA making that pivot was big. You know, that's the first time I think there was news. Lael Brainerd, I think it was Lael Brainerd yesterday, said, you know, we've got to be data. We've got to let these moves that the central bank has made filter through. So that was kind of a good sign. I think that's kind of helping the bounce here this morning. But technically speaking, man, we're just hanging on, you know, off the edge of a cliff there relative to the June low. Some markets are below it, some are above it. And, you know, technicals, I would say, reign supreme here, you know, in terms of relative strength and relative weakness. Stocks you want to be long, stocks you want to be short. It's all relative to that June low. That's just such a key barometer. So that's all I got.
Yeah, we're also up against the in the S&P 500 currently, the 200-week moving average, which is an area of interest as well. Speaking of the technicals, let's take you through the indexes. We're going to go through the S&P, the NASDAQ, the Russell 2000 small cap index. Anything specific that you guys would like me to cover? Chat and team included.
Do your magic.
All right, sounds good. Let's hit it, and I will see you guys on the other side. Catch you in just a few. All right, good morning once again, and thank you guys for tuning in with us. Let's hit it. Hard right edge of the trading analysis edition of the MotiveWave platform, looking first at price action in the S&P 500, and I felt it would be appropriate to take the opportunity to take a step back and look at the chart going essentially back to the September 2018 highs and just kind of put the move that we are currently seeing into perspective. And although it has been a bit of a bumpy and rocky ride overall and a volatile year filled with, you know, multiple catalysts on either side of the table, we've continued to view this overall sequence and pattern as a corrective trend. And as we approach what could be the end of this correction, provided it is simply a standard 535 zigzag correction, as we approach the end of it, I feel it's important to begin identifying the downside support zones, the initial downside support zone, and then, of course, what the alternate would be in the event we were to violate that and see downside continuation. So looking at the daily chart, it's amazing going back to September of 2018 and into the December 2018 lows. At that time, Todd and the team and I were viewing this as the cycle degree fourth wave correction. We get this A, triangle B, breakout up in C, move to the pre-COVID sell-off. At the time, we had this as a wave 4 triangle, and I find it very fascinating that the coronavirus came along and set the social mood up such that a more sharp and impulsive move to the downside presented, and that essentially turned the fourth wave into an overall flat, which, by the way, demonstrated near exact equality to time elapsed in wave 2 of the same degree. A very key guideline when working an overall impulsive structure. So from the March 2020 COVID low, there have been a lot of Ellioticians looking at the recent November and January area index highs as the end of the green cycle degree wave 5 rally, meaning the trend wave from the credit crisis lows, at least, in their opinion, has come to a completion. Where I've been of the belief that we only have 2 trend waves here separated by 1 corrective wave. And this continues to support the idea that the correction that we are currently seeing is simply a wave 2 of higher degree 5th position. And when we then take into consideration our next wave 5, cycle degree wave 5 fib objective, given the fact we have already exceeded the wave 5 and 1 equality, it would make a lot of sense that we are in the process of forming and trading out an ending diagonal of the contracting variety. So I do think a tradable low should present in the near future. So let's go ahead and zoom in on this trend going back to the January high and just kind of talk about where we've come. And as you know, we've gone back and forth on whether or not this should be counted as a traditional 535 zigzag correction, or if in fact it would be more appropriate to view it as a complex development. And the complex development is simply a string of Elliott wave corrections. So I don't feel there's a huge difference here, and we've kind of identified what we would need to see to deem this to be a completed zigzag versus what we would need to see to view this to be a completed complex. And really, although per Robert Prechter's most recent edition of the Elliott Wave Principle Handbook, this leading contracting variety diagonal is not valid due to the fact wave 3 is longer than wave 1. Even Robert Prechter himself acknowledged that perhaps those rules need further clarification and research. So my opinion, and I think the team is in agreement, that given the NASDAQ, the Russell 2000, and the Dow Jones Industrial Average charts can be counted from November and January down to June as a MotiveWave, I feel it's appropriate to allow for the S&P to be an exception to the rules and just view this as the most basic of patterns. And that would be this contracting wave A, 5-wave move in A, a sharp 3-wave retracement into the summer, and now we're simply rounding out 5 waves down here in wave C. So we've continued to view this as a wave 4, or I should say going into last week, we were looking at this as either a wave 4 or the resumption of the uptrend, with the September 30th low potentially offering completion of the complex correction. I don't think we can view the complex correction as a candidate at this point, given the fact we've had a new low present and now have 5 waves to the downside. But the question now becomes, how low will this green wave 5 go, provided this is a zigzag? And I've continued to bring your attention to the 1272 external retracement of the summer rally. The 1272 external retracement of the summer rally, as you know, is often the target when the 786 is turned into either support or resistance. So depending on if you're working an uptrend or if you're working a downtrend. And allow me to show you a quick example of this. If we take into consideration a retracement of the summer rally, you can see the 78.6% retracement, which we did breach, essentially turned into an area of resistance moving back through it. And so that opens up the 1272. And what's really fascinating about the 1272 downside objective at 3469 is this. When we take into consideration the subdivision of blue wave C and look at wave 1, 2, 3, 4, and now wave 5, and consider the various fib relationships of this sequence, you'll notice that our third wave is just beyond equal to wave 1, but not a 1618. Our wave 4 was pretty much exactly equal to wave 2. And when these two conditions are true, more often than not, I would say 6.5 times out of 10, your fifth wave is going to be a 61% relationship compared to 1 and 3. So what we can now do is bring that fib zone in, which comes in at 3389, and we can further begin to identify the green minor degree wave 5 fib zone. And you'll notice as I fill this zone in, it begins to stack right around the 1272 external retracement of the summer rally. So this I view as the highest conviction downside zone of interest. So my game plan is as follows. I feel we have wave 1 and maybe even wave 2, or we're in wave 2 of green 5, but then I do expect a continuation down to this zone, which you can see is right around that 1272, and more importantly, has confluence with the corrective trend channel. The corrective trend channel takes into consideration the all-time high, through the B wave with our parallel trend line over the low of the wave A. So that's the zone I'm after in the S&P. I think 34.5 to 3,500 is a given at this point. It all depends on how long we're going to spend in this consolidation, or if we're just going to expedite our move down to that zone. Now, what happens if we don't hold that zone? Well, in the event we don't hold that zone, that's when we can open up the idea that perhaps we're going to see a 100% relationship of blue C compared to blue A, which would simply be a measured move decline. And what's interesting about that level is if we take into consideration a standard Fib retracement of the rally from the COVID lows, the 50% Fibonacci retracement comes in at 32.49. So again, 34.50 zone, zone 1, if that breaks to the downside, I'm going to begin to look towards 32.64 and then the 50% retracement. But as we begin to potentially round out this correction, I feel it's important that we're also looking at what opportunities might present once this move has come to completion. Now, what happens if inflation really gets out of hand and we do see an unexpected downside catalyst? Could this potentially be a larger 1-2? Yeah, absolutely. Do we think that's the case? No, not at all. We don't feel there is sufficient evidence to substantiate such a bearish call in the markets, and we would only keep this on track as a back of the pocket alternate. Okay, really quickly, I'm going to wrap it up with the NASDAQ. Looking at the NASDAQ, same situation. We have an instance where we are tracing out 535 Elliott wave zigzag correction, which you'll notice in this instance, we do the exact same exercise with the 1272 of the summer rally at 10402. We'd look inside of blue wave C, and in this case, our fib zone sits just beneath the 1272 fib objective, which is right where the lower boundary of the corrective trend channel sits. Over to Russell 2000 small caps here, we are looking essentially at the exact same situation, kind of this 5 down of A, 3 of B, looking for 5 waves down in C. I do think we make a new low here. I don't think this trend is over. But it's certainly not demonstrating urgency to the downside, which would not be in favor of the really bearish 1-2-1-2 possibility, which is a positive development for those who continue to view this as a corrective wave, which we do. All right, that's it from me. Let's jump back over to the team. What do you guys think?
Yeah, in agreement there. I was gonna show the NASDAQ, very similar account, and you know, it's interesting just on the intraday, just because I'm managing a downside put spread to hedge longer term holdings, so I don't have to pay taxes on longer term stock holdings. But it's interesting, the debate over the leading diagonal, and we did an Elliott wave event a month or two ago, and a couple different people had sort of debated the merits and the requirements of the diagonal. So the team at Trading Analysis, we've gone back and looked at writings from people who were close to R.N. Elliott, trying to figure out what constitutes a proper leading diagonal. And there's a lot of debate in the Elliott wave community. Of course, there's a lot of people who have interpreted R.N. Elliott's work back from the 1930s, 40s, and 50s. So it's interesting. It's a nice little intellectual pursuit. I don't think we have an answer that we're ready to stand behind as a team, but I think we'll be addressing that at some point.
Yeah, absolutely. We will most certainly be addressing that. Well said. And just to address a comment in chat before moving on, the comment was the count keeps changing. It is now looking bearish. I will say that going into August. Going into August, we expected August to really be the decision month. And under 39.45, that confirmed the move to 36 new lows. The only difference between the complex count, the WXYXZ, which does confuse many, and the ABC zigzag is the WXYXZ would say that from August 16th down, you complete in 3 waves. The 535 zigzag would say you complete in 5 waves. So the implications are very similar, as are the downside objectives. Now, to your point about the more bearish scenario, that is something we're still considering, but we would certainly need to see evidence of downside acceleration and further evidence of capitulation to even consider that idea right now, I think. All right, Todd, you got the screen?
I think so. Yep, ready to go.
All right, take it away. Screen is yours.
Thanks, bud. Just following up, and again, I'm running the longer term portfolios for the wealth management, but I'm monitoring the markets like as if I'm a trader, which I'll always be a trader. with so much happening, below the daily time frame, it's important to get in here. So I rebalanced the portfolios. I put some hedges on for clients. We put some inverse ETFs in. We put some short-term treasuries in, raised some cash. And I was watching this little setup, and Bennett sort of left off. And maybe, guys, I'm going into too much detail here, showing what we're really working with the members. But this is my own interpretation, and just kind of watching this most recent sell-off here in the NASDAQ. There's the first fib support zone right in the NDX at about 10,008. And that comes from a few different things. So if this is a 5-wave decline, the question is this 3, this 4, and this 5? Meaning, do we have a completed 5-wave move down? And if you kind of hide some of those degrees and simplify it, the percent distance change here in 1 is very shallow compared to here. Not wrong, but not likely. So the question is this possibly a continuation in this wave 4? And as Bennett just said, do we make new lows? Well, we did hold the first fib support zone, which is a 61% relationship, that 5E1. That means you take percent distance change in 1, multiply it by 0.618, and that's right there. The 1272 is the external retracement. Bennett, I think, just mentioned that. This little move up here down, and then another 38%. That's wave 1 pushed down into 3 and 5. So first support zone was there. Then the next one is down here at about 10,250 in the NASDAQ. So if we were to fail following CPI and just continue to break on down, I would say we get to a bottom sooner. And that would secure wave 4 going here, and we're just going to push down. But if we do break up, we can go into a variety of different corrections here over the next even couple of weeks, and then ultimately head back down. So, I did something with, I did a video with our members yesterday. I have a put spread on, and I'll show it to you. And basically, this is a good way to manage a put spread. So I have just a 1 lot on here. I'm hedging longer term, long holdings in like Apple and XLK. I don't want to pay the taxes on it, so I'll hedge on the downside. So I had an 11,100 put long, and then sold a 10,500 put. So 600-point put spread. Paid about $14,000 for it. It's a $60,000 spread. So $60,000 minus 14 grand, that's your max profit. So, we went through a nice little lesson, I think, for members. And this is something, if you guys are options traders, that you might want to think about. How do you manage a 1 lot spread? Do you take the trade off, or is there a different way to sort of manage it? And again, it's great matching up the different wave count possibilities with your option structure. So I went through a video, and what I did basically is, rather than take the trade off, I butterflied it. So basically that means is going from a put debit spread to a put butterfly. So I sold another one at 10.5, bought lower protection at 10,000 in the NASDAQ. And again, 10,000 in the NASDAQ is below both fib support zones, which I feel pretty strongly that it will hold unless we have something catastrophic. The resulting trade, this is a snapshot from the video on trading analysis. I'll just take that out. So this is the new look. I had max loss still possible going into the October 21 expiration, which was 14,000. Now by butterflying it off, you can look at the teal here. They only have $3,000 max loss. And if we can somehow pin around 10,500 in October 21, I increased my max profit from 45 to 55,000. But here's the downside of the butterfly: you do fall off, right? If you really crack through those support levels that I just mentioned, then you still face a profitable situation, only $7,000. It would be the worst case, and then it moves up as you get closer to that. So a good way to manage a debit spread is to butterfly it off into fib and wave resistance. Hopefully that makes sense, those of you who are trading options. One thing that kind of shifting gears here, which I think is a bullish situation. And I had a couple people asking about small caps. It's pretty amazing what's happened with small caps compared to large cap. So this is your different market capitalization ETF. So micro, mid cap, small cap, which is Russell 2000, mid cap, and that. So, oh no, sorry. This is what I wanted right here. Okay, here we go. So reset that. Large cap, which is your top 200, mid cap, which is here in green, and small cap, which is in white. So this is a month over month relative rotation. You can see that being that the red top 200 is furthest to the right on a month over month basis, large caps still have the edge. But then you get down to mid cap, you're moving out to the left. That means there's been, a good 6, 12, 18 months of underperformance, but the mid caps are hooking up. And same thing, big time underperformance in small caps, but the small cap 2000 is also making a big turn back towards the north. So that's the monthly. And then you break down to the weekly chart. Each one of those little dots is 1 week of trading. Look at the move that 2000 small cap, the Russell 2000. This is simply your IWM ETF, has made a strong move. We've got good relative strength compared to the benchmark S&P, and we're picking up a little bit of momentum over mid and large cap. We're seeing a very significant move into small cap stocks. And as you go to the next screen, you look at, let's go to the, that's the one bad thing about Optima, it kind of bounces around. I mentioned in the beginning, all relative to that June low, right? So the IWM small caps are still above the June low. And if you just look at the relative strength in a different way compared to the S&P, it's been very strong July, August, September. Then we've just kind of gone sideways. But you look at this, the moving average is about to catch up to IWM and to the S&P. I say it's starting to break out. So not only is it holding these June lows, holding these September lows, but it's also well above the June low. So small caps are great. So, same situation. Let's take a look at what small caps are performing here. And this is going to be the monthly, so it's going to be a lot less responsive. We've had small cap outperformance in value, and this is small cap value, mid cap value, and here's your Russell 2000. The growth, mid cap growth, and the small cap growth are still down here in the bottom left, but they're beginning to hook higher, which for most of you, I think you're active traders, active position traders, managing your portfolios longer term. That's notable. And then you get over here to the weekly. The weekly is a much different situation. You look at the week going back here into September, and we can probably get some August in there. The small cap growth, Russell 2000 growth, has made a strong move. Slightly less strong is the mid cap growth. Here's your Russell 2000 that encompasses everything. And then, okay, the value stocks. Now, this is a little bit of the situation that we're in. Value mid cap and value small cap have been down here in the lagging. They're trying to make a move higher here. So we have the battle going on right now between small cap growth, Russell 2000 growth, IWO, and small cap value, IWN. It's interesting. I think they both can continue to be strong because small caps are trying to take on larger caps. But who's going to win and who's going to lose? Small cap value and mid cap value, or small cap growth and mid cap growth? And this is something that I really want to watch. And there's a lot of opportunities, I think, to be like a long short hedge fund. You want to be long the strong stocks in here, based on that wave and Elliott support that Ben and I showed you at the top. But if we do by chance get a nasty CPI print, and who knows what can happen on the geopolitical front, get a big push down, where do you want to focus on the short side? Obviously large cap, and is it large cap value, large cap growth? It's probably going to be something we got to go into a little bit more depth, but you got to be a two-way trader in here. So I'm going to finish real quick. Just looking at the macro overlays. This is something I think is so important in here. We mentioned this. So this is just a daily of S&P futures here in white. We are breaking through those SEP and June lows. You look at the overlay of 2s and 30s, 2-year treasuries, 30-year treasuries. I'm going to get the dollar out of the way right now. Treasuries making a new low. That is not good for stocks. Treasuries making a new low. Interest rates are going up. I'm going to finish here with the interaction between short-term treasuries and long-term treasury yields. But as long as treasuries keep pushing lower, yields going up, you're going to have a continued pressure on the stock market. Crude oil has been, as I mentioned, trading with the stock market. Okay, so crude down, which is in yellow, S&P futures in white. This isn't the best overlay. If I isolate these two, you'd see a better correlation, but take my word in the interest of time. And then the dollar, okay, if treasuries moving lower, yields pushing up, that increases the attractiveness of the US dollar. Treasuries moving lower, yields moving up, hurts the stock market because obviously you're just trying to rotate out of growth because of, future value, future cash flows, resetting the interest rates. And then the stronger dollar is going to hurt multinationals, which again is why small caps are showing so much relative strength in here. The dollar is not breaking new highs. And I'm curious what Alex says. Dollar's not breaking new highs. Treasuries are starting to try to hold these lows. Crude oil, I think going up is a good thing. Inflation is not trading based on inflation. It's trading on the Fed and central banks trying to squash demand. And I think the higher commodities go, the more likely that the Fed is going to pivot and not drive us right off the cliff into economy. So you want to see commodities going higher. That is not fear of the inflation trade. That is fear of recession aversion. Finally, I just want to show you, I'm sorry for taking so much time. A lot of talk over yield curve. So we just talked about 10s and 30s. Okay, so a lot of stuff going on here. We get rid of the S&P. Purple line is what I want you to focus on. Purple is the spread between the 10-year treasury and the 3-month treasury, the yield. In gray are your recessions. So every time you get the purple line moving below zero, that is the 10-year treasury yield moving above the 3-year treasury yield. This has not entered negative territory. We've not seen 10-year, 3-month yield curve inversion, which happens prior to almost every significant recession, prolonged recession, right? You have it here, recession. Here happened coincidentally, recession happened before, recession happened before, recession happened before, recession happened before, shortest recession on history. We're coming back to retest it, but 10-year, 3-month yield is not inverted. And if you get down to the 1 year, kind of zoom in here a little bit, it's starting to make a move up off the lows. So you're seeing a separation between the 10-year and 3-month yield. And if the 10-year yield wants to continue higher, while the 3-month, which indicates where the Fed funds are, if you get higher yield on the long end of the curve, I think that's okay for stocks because that's going to ensure that this yield curve doesn't invert. So don't be afraid of what I just said earlier. Longer term treasuries continuing to drop. As long as we can do it in a controlled manner, I think there's going to be a continued bid for stocks, specifically from U.S. investors and international investors who are doing the carry trade. I do think there's international demand for our stocks. And we got to see, obviously, we're coming to earnings season. So see what happens. Sorry for taking so much time. Guys, over to you.
No worries. Much appreciated, Todd. Thank you for joining us this morning. All right. Passing the screen to your direction, Terry. We've got about a minute and a half left until the market bell. All right. You ready to rock?
Thanks for that, Todd. Appreciate all those comments. Yeah, go ahead, Bennett. We're good.
Yeah, Todd, interestingly enough, on TLT, before you go, I am seeing a potential 5-wave move not far from completion on the downside there. So I think that's something to keep our eyes on as well.
Yeah, I'm from the August 1st high?
I believe so, yep.
Yeah, I'm seeing the exact same thing. That is going to be I got huge fib support zone, 98 to 95. I don't know. I'd love to sell some puts in TLT. And there's other thing, bond volatility is massive right now. Bond volatility is, I'm going to guess, equivalent to a 40 or 50 VIX in the S&P. So anybody who's feeling spicy, if they want to try to do something, sell some puts below 95. That might be a trade I put on. You get paid to accumulate it if again you're feeling spicy and you have good risk control.
Absolutely. All right. Appreciate you joining us. Terry, ready to take it away?
Yes, sir.
All right. Screen's yours. Have a good one. We'll see you on the next one, Todd. Thank you.
See you guys jumping into a
All right. Hello, traders and investors. I'm Terry Long at tradinganalysis.com with your weekly sector focus. As we've said, investors are anxious to see the FOMC minutes release later today, followed by this month's inflation and CPI figures coming out Thursday morning. Uncertainty drives market volatility. So the fourth quarter started out with a bang. As markets first rallied sharply, taking back half of September's losses in just 2 days, but obviously ended the week in a whimper after hearing the non-farm payroll figures on Friday, which didn't meet investor expectation. Good news is bad news, so lower unemployment's not good when the Fed's trying to tighten things. Now, despite Thursday and Friday's give back, the S&P did hold a net positive 1.51% last week, and the NDX managed just a 0.62% gain on the week. Now, most of all of last week's gains have all but evaporated as the S&P has declined another 1.4% in the first 2 days of this week's trading, and the NDX is now down another 2.25%. And has moved back below the June lows. Now, pre-market action has those futures moving higher, recovering some of those early week losses. And I just heard the bell, so the market is now open right now. I think the S&P is back down 0.17, so it was up earlier, and it's still kind of trading shallow. Now, last week saw the energy sector roaring back to life, jumping 13.5% on news that OPEC would be cutting their target production rate by 2 million barrels a day. Also remaining positive last week and outperforming the benchmark was the industrial sector, up 2.8%. The materials sector up 2.13%. The communications and financial sectors were both up about 1.75%. And the technology sector actually holding 1.65% or 68% gains last week. Now, underperforming sectors were healthcare, utilities, and real estate. They all went negative for the week, with the XLU and the XLRE the worst performing sectors. Now, so far this week, let's look at here. The staples sector has been holding its own. We're up 2% this week in 2 days of trading, plus this morning's price action. The industrial sector also slightly net positive here by about 0.21%. We have energy, technology, and communications are the worst performing sectors, moving lower by 2% or more. There's financials also down 2.1% on the weekly totals. All right, moving on to our relative strength sector leader scoreboard, we see the utilities sector's relative strength lead continues to decay after forming a reversal hook back to the southwest. And the energy sector has made a massive push back up into the leading quadrant with rapid gains in both momentum and relative strength. You can now see energy back up in first place in terms of relative strength leaderboard. The consumer discretionary sector does show some declining momentum, but I wouldn't fear that. It is retaining its relative strength outperformance here in the leading quadrant. So that vertical decay is basically a change in momentum at a constant relative strength move. Now, the industrial sector kind of just continues its eastward trek here. And I'm going to tell you what, there's two stocks I like in the industrials. That's John Deere and Johnson Controls. Now, the vector movement week over week is not as fast moving as the other sectors. Nevertheless, in the industrials, both relative strength and momentum gains continue driving it further into the leading quadrant. Now, the staples and healthcare are down in this weakening quadrant, though now both are seen climbing northward with renewed momentum gains apparent. The technology sector has moved down into the lagging quadrant. And it should be very clear that any rally attempt from here is not likely to be coming from the tech sector. Now, this week's vector also shows the financial sector has moved into the leading quadrant. And for the past 5 weeks, it had a rising blue improving trend vector. And now we see it actually has penetrated into the leading quadrant, and the price trend action on the weekly has turned green, meaning it is in a leading structure. Now, down here in the lagging quadrant, we can see the real estate sector actually accelerating deeper in a southwesterly heading as it gives up more relative strength and momentum week over week. Now, the materials sector hasn't really been gaining much ground with respect to relative strength, kind of vertical, kind of the opposite move of consumer discretionary. It's got rising momentum in the materials, but we're just now starting to see that eastward tilt, which means we are starting to pick up some relative strength as the materials sector has now taken its place up here in the improving quadrant. Now, the communication sector, it has the lowest relative strength ratio of all the sectors, but there is a change happening. It has formed a new northeasterly hook. You can see that reversal action happened last week, and we need to monitor this, but we may also see the communications make a return back to the improving quadrant. I wanted to mention something back about the utilities. Money has been moving out of the utility dividend plays, and let's take a quick look here at the price chart of the XLU. Todd and I were discussing this prior to the show, and all we could really think of is it was similar to the move out of bonds. Now, that money has to be moving somewhere. So as you can see here, the utility sector, which was our sector, but now you're seeing dramatic relative strength loss here, nearly 19% decline since September. That's September 12th, right? So 20 days, 21 days of trading on a lot of money. I still see a bearish MACD here. So money moved out of the dividend, cyclical dividend, and I think that's very interesting. All right. Any comments on that, Bennett? I'll send it back to you.
Very good. Much appreciated. And my apologies for cutting off Todd there. He had to take off for a client call. And we've got about 7 minutes here into the bell. As you can see, markets are quiet now. Yeah, very interesting developments there in the utility sector. You know, communications, it's interesting to see how back and forth that sector has been in terms of relative strength and performance over the past, 6 or so months. Netflix actually has an interesting pattern off of its low that could be trend establishing, which is counterintuitive in the markets that we're currently in. Alex, sir.
Alex, did we lose Alex?
I think we may have.
He looks frozen. I handed him off the screen and he didn't accept it. So
no worries.
Alex, he looks like who is that? The thinking man.
No worries.
The statue, the thinker. Oh, Alex.
It happens. It looks like he's having some technical difficulties. He will be on for Crypto Lab tomorrow. Let me do this. If you guys could just bear with me for 2 seconds, I can pop open, take you through crude really quickly before we wrap up. All right, let me jump in here, Terry, and I'll take him through crude and the dollar in case he does not make it back. All right, so let's take a look here before we let you guys get out of here and review the current developments that I am seeing in crude oil. and then we can take a look at developments in the US dollar. Now, I had an interesting discussion with our clients last night in regards to the overall structure off of the 2020 lows for WTI crude oil specifically. And what we had originally done in terms of the wave count is identify the sequence that you see here in blue 1 and 2 as the higher degree of trend. And when it comes to the concept of a degree violation, we typically would prefer to see a higher degree correction always be longer in duration. There are instances where the higher degree correction is actually smaller in terms of percent change, but as long as the higher degree parent wave is of a longer duration, it's not truly a degree violation. Well, interestingly enough, in the case of crude oil, perhaps it's reversed in that the largest percent change move from the 2020 lows is the wave 2. The smaller percent change move of 23% is of the smaller degree sub wave 3. And what's interesting about that is if we then compare this potential 1-2 to what we saw here from March in through the late September low, is this correction was nearly equal to what we saw back in April through the end of April of 20. And let's see, just check and make sure Alex didn't make it back. And so what's interesting about this wave count is it still leaves open then the possibility that in the case of crude oil, the consolidation from the March 130 handle high is in fact a bullish consolidation. The 100% relationship of wave C compared to A, as you can see here, did attempt to hold as support. We ultimately breached that zone and kind of rounded out into around 76. And that was just above the wave 4 and 2 equality. From those lows, there is evidence of a potential trend wave up. So now that we have evidence of a potential trend wave, 3 waves back is going to paint a picture of continuation back towards the March 130 handle area high. So perhaps this is an instance where the trend has been corrective, but the catalyst, that being what Saudi Arabia and Russia did, was perhaps a bit delayed. And we're now seeing that trend wave establish. And then over to the dollar index. Taking a look at the dollar index, Alex has continued to view this going back to 2008 as a 5-wave rally, with price action now in wave 5 of the final higher degree wave 5, which would be a cycle degree position. What's interesting about this zone is in terms of the fib associated with green wave 5, we've exceeded those objectives, and we're now looking inside of green wave 5 at the orange wave 5 fib targets, which interestingly enough, the 61% of orange 5 compared to 1 and 3 does take us right to the 2-4-3 Elliott derived channeling technique. And as we move off the 2-week down to the weekly, down to the daily, down to the 195, the last really strong high conviction zone of support that was offered was in August. August, we had a confluence of objectives there, multiple degrees of trends, projections and retracements, all stacking up. And what followed was a 3-wave measured move rally. So the major indexes did 3 to the lows, and the dollar did 3 to the highs. That suggests, if you respect Elliott Wave, that in fact those trends are still alive and well, meaning the uptrend in the dollar is still alive and well, and the downtrend in the major market index is also still alive and well. So I'm now looking at this, I think Alex is as well, as some sort of a potential ending contracting variety diagonal. He will be with you tomorrow for Crypto Lab, and he will also take you through the macro scene. Let's see if he's back with us. Oh, we've got him back. We've got him back here. Let me see here. Let's jump in. Alex, sir. How are you doing, brother?
Sorry, unexpected
No worries.
interruption.
No worries. It happens. Do you want to save it for Crypto Lab, or do you want to jump in? It's up to you.
Oh no, I think he died again.
All right, all right. We're oh, there.
Oh, there he is. You back?
Yeah. Sorry, guys. Something is going on with the machine.
No
Okay.
worries, man. No worries.
Would you like to continue, or you want to wrap it up?
It's your call. If you want to save it for Crypto Lab and invite him tomorrow morning, or if you want to jump in.
Sure.
Up
Yeah.
to you.
Let's keep it for tomorrow.
Okay. Yeah. That way, in case you're having any internet issues, heck, it could be on my end for all I know. There's been some connectivity issues actually with the central Dallas data center. So I've been having some packet loss to the West Coast, packet loss to the East Coast. It's always a good time. Always a good time. Well, hey, we appreciate you all taking time out of your busy days to join us. Members, we will see you in approximately 16 minutes for our weekly member webinar. Alex will be back to take you through the crypto and macro scene tomorrow morning, same channel, 9 a.m. Crypto Lab with Alex. If you did enjoy the content, please give it a thumbs up. Subscribe with notifications. It's a great way to support the trading analysis team. Doesn't cost you anything. It lets the YouTube algorithm know to distribute it accordingly. Gentlemen, good stuff.
All right.
We'll see you guys next week. All right. Take care. And we'll see you also tomorrow morning, Crypto Lab with Alex. Have a good one.